Market volatility, friend or foe. So foe is an enemy, something that is out to get you. Friend is your pal, something that is out to help you. With the downward volatility we've been experiencing in the stock market and also in the bond market since August, it can feel like stocks and volatility are our foe, out to show us where we're weak, where we feel like we cannot take the daily decline in our portfolio. If we had someone in our lives that was not cooperating with what we wanted them to do, and it seemed like their behavior was adversely affecting our life, we would question their friendship. And if in a similar way, it feels like we want to distance ourselves from them, and we can feel that way about our stock investments in our portfolio, that we really want to distance ourselves and get away from them because we don't like the way they make us feel. So why should we put up with volatility? What if volatility in stocks is different from that of humans? So consider that interest rates are under 3% right now for high-grade, low-risk bond investments. Consider that we would have to hold a bond for 10 years to get back less than 3% a year. And that also it would be a sure thing of getting back our investment plus the 3% a year. That's what a high grade, like a treasury bond, something like that would be. Any change in the price of the bond wouldn't matter. It would be a moot point because we know we would get our money all back when the bond matures. So just to contrast that, let's take a look at stocks. Are we guaranteed to get our original investment back after 10 years? No. So to reward us for our risk and the inherent volatility, we get a higher rate of return. The average for the S&P 500 companies that make up that index, it's averaged over 5% per year for the last 30 years. Most people need more than a 3% average return to make their money last in retirement. And that's what we're looking at with high-grade bonds. Very, very low risk. Even lower rate than that if we were looking at a bank CD, much lower rate than that. So you just need to understand this, that you cannot get an increased return without the volatility. You have to take volatility to get an increased return. No volatility, no extra pay. So you get paid extra to put up with that discomfort. No extra pay. For most people, no retirement plan that lasts. It may not feel like it, but you are actually getting paid to be patient, to wait, and to feel discomfort. You're actually getting paid extra for the discomfort and for the patience. So my question is, can you make your money last over a long 30-plus years in retirement with rates as low as we are seeing now? For the vast majority of us, the answer is no. So, in that way, be glad for the volatility. You're getting paid extra for it, and you do need the extra pay.